Okay, let's look at kit questions on final topic, project or investment appraisal. Okay, let's start. Building society adds interest monthly to investors' accounts even though interest rates are expressed in annual terms. So interests are added annually, monthly. So normally you would assume it is compound interest unless it is specifically told. The current rate of interest is 6% per year. An investor deposits 1,000 on 1st January. How much interest will have been earned by 30th June? Okay, so interest is 6% per annum and it is added every month. So divide by 12 become 0.5%. So 1,000 multiplied by 1.005 power by the end of June, 6 months. So the amount would be 1,030. So you need to see how often the interest is added and see whether the interest that is given is annual or is it monthly. So total amount would be 1,030. So the interest would be 1,030 minus 1,000, which is 30.38. A 1-year investment yields a return of 15%. The cash return from the investment, including principal and amount, is 2,070. What is the interest? So this is the amount that we received. This is the future amount. So what we can do is discount this to find the original amount. And then the difference would be the interest that has been earned. So if this is the future amount, remember when we roll interest into, like in this question, if I take this 1,030 and multiply by 1 divided by 1.005 power 6, it will give me that original amount, which is 1,000. So it's the opposite of that is called discounting. So discounting is used in NPV as well. So if I take 2070 multiplied by 1 divided by, so the thing is we have 1 divided by that compounding formula. Divided by 1.15. So it is a 1-year investment. So we don't need power. So 1,800 is the original amount. If 1,800 is the original amount, then it means we have invested 1,800 and 270 is interest. If you take 1,800 and multiply by 1.15, it will give you that amount. So the interest is 270. What is the amount to which the principal would have gone by the end of year 3? A single sum of 12,000 is invested at 8% per year with interest compounded quarterly. So every 3 months. So what is the total amount to which it would have gone? So if interest is 8% per annum, so we will have 2% per quarter. So 12,000 multiplied by 1.02, and they're asking about 3 years. So 3 years multiplied by 4 quarters. So 12 periods. It will be 15,217 if we round it off. They said, what will be the total amount? What is worth more at present values, assuming an annual rate of interest of 8%? 12% in exactly 1 year, 1,200 in 1 year, 1,400 in 2 years, 1,600 in 3 years, 1,800 in 4 years. So you wouldn't know it without calculation. So let's calculate each of them. 1,200, if our rate of interest is 8%, so divide by 1.08. We don't need power because it is first year. 1400 divided by 1.08 is still same percentage, but the difference is now it is 2 years later. And then 1600 multiplied by 1 divided by 1.08 power 3. Remember, you can take these discount factors from the table that is given. Okay, like this is for first year, second year, third year, but for me it is easier to just calculate it. So I make a habit of calculating it because it will help you in future papers as well if you are able to calculate it. So then we have the fourth year. So you can see that 1800, it is big amount as well. Even though it is received in fourth year, the value decreases, but it is still more than all the other options. A bank offers depositors a nominal yearly 4% interest per annum, or interest payable quarterly. What is the effective annual rate of interest? Effective means what does that equal to? In simple interest, it is 4%, but in compound interest, it becomes more than 4%. So you can imagine an amount and then calculate what is the difference in amount, or you could just take 1 multiply by 1.02 power 2. So it becomes, if it is given quarterly, so divide by 4, it will be 1% per quarter, and we have 4 quarters, so 4 periods. So 1 will grow to 1.04. So this growth is the interest. So 4.06%, which is D. What is the IRR for this project? A project requiring investment of 1200 is expected to generate return of 400 in year 1 and year 2, 350 in year 3 and 4. If NPV at 9% is 22, at 10% is minus 4, what is IRR? So we need 4 things. We need lower percentage, higher percentage, and PV of lower percentage, and PV of higher percentage. And one gives us negative, another gives us positive. So we know that the answer should be in between them. So any answer that is above these two or below these two will be eliminated, like this one and this one can be eliminated. So if you don't have time, you could just make an educated guess as well. Now if you see, the answer will be in between them, but 4 is more closer to 0 than 22. It means the answer would be more closer to 10 than it would be to 9. So 9.5 would be exactly in the middle. The answer would be above 9.5. So here the closer one is 9.85. So without calculation, I would assume C to be correct. But let's see. We have 0.09. I will leave it here. I will do other calculations and I will add it with this one. I break down calculation in parts mostly. So NPV of lower discount rate divided by NPV of lower discount rate minus NPV of higher discount rate, but minus into minus equals plus. Now take this, multiply by higher percentage minus lower percentage, which is 9%, 10% minus 9% becomes 1%. So it becomes 0.085, 0.09 plus 0.0085 becomes 9.85, which is 9.85 B. So this formula either gives you correct answer or wrong answer, and also you will know from your educated guess as well where your answer should be. A sum of money was invested for 10 years at 7% per year and is now worth 2,000. What was the original amount invested? When they ask about original amount, they are usually asking for discounting. So it is now worth 2,000. It was invested at 7% per year for 10 years. So multiply by 1 divided by 1.07 power 10. So it would be 1,060, or round off would be 1,017. If I take one, if you are not sure, you could just double check it. You could do this calculation to find back the future value, and you can see it is correct. House prices rise at 2% per month, per calendar month. What is the annual rate of interest? Correct to one decimal place. So some of you might take this 2% multiply by 12, you would assume 24. But remember, you always assume that the effect is compounding. So it is 2% per calendar month. They didn't say 2% per year, and then you have to calculate per month. No, it is per month. So 1 multiplied by, so I'm basically finding what will be the value of 1. And the increase would be the percentage. So 26.8% would be the answer, which is B. What is the present value of 10 annual payments of 700? The first paid immediately and discounted at 8%, giving your answer to nearest dollar. Now this is annual payment. Annual payment means annuity. So one thing you could do is do separate calculations for each year, and that will give you right answer. But if you know annuity, that will save your time. So we have 10 payments, but the first is paid immediately. It means in year 0. So if first is made immediately, that means it ends in year 9. So I will go to annuity table and check 8% and at 9 year. So we have a 9 year, this is 10 year, this is 9 year. So we have about 6.247. 6.247. Now this start from year 1, but we have cash flow in year 0 as well. So discount factor for year 0 is 1. We could just add that and now take 700 multiplied by 7.247. 5,073 would be your answer. What you could always do if you are not sure, take each year discount factor individually, and that will give you correct answer. But obviously that will take a lot of time. What is the rate of interest to nearest whole percentage? An investor is to receive an annuity of 19,260 for 6 years commencing at the end of year 1. At the end of year 1 or year 1 means the same thing. When they tell you year 1, it means normally end of year 1. When they say year 2, it normally means end of year 2. So end of year 1, don't be confused by it, because we normally assume that cash flows occur at the end of every year. So an investor is to receive 19,260 for 6 years, so annuity. Commencing first payment is year 1, which is normal. It has a present value of 86,400. Now, if I take this question, this previous one, and I divide by this was the total amount, yeah? And this is the annual cash flow. If I divide by total amount by the annual cash flow, it gives me that factor, like in this case, yeah? So in this question, if I take 80, if the total value is 86,400 and divide by 19,260, it will give me that factor, because this would be multiplied by something to give us this total value. So if I take total value divided by this annual cash flow, it will give me that annuity factor. And this is for 6 years. Starts at end of year 1, so if it is for 6 years, it ends at exact 6 years. So what I will do is, I will go to annuity table, and in 6 year, I will see which one has this factor, 4.486. 6 years, 4.486, 9%. 4.486. So 9% is the answer. How much should be invested now to nearest dollars to receive 24,000 per year in perpetuity if the annual rate of interest is 5%? So in simple terms, they're asking what is the value of 24,000 forever. The value of 24,000 forever starting at year 1, which is normal annuity, just taking the amount divided by percentage for 80,000. If it started from some year in the future, or if it started from year 0, it would have created a problem, but here it is straightforward. The net present value of an investment at 2%, at 12% is 24,000, 20% is minus 8,000. What is the internal rate of return of this investment? Okay, 12% gives us 24,000, 20% gives us minus 8,000, so answer should be in between both of them. So let's calculate it, because we can select an answer here. But remember, before I calculate it, I need to know where the answer should be. Middle of both of these will be 16. Because 8,000 is more closer to 0, then the answer would be very closer to 20%, which means it will be above 16%. So we have a lower discount rate, which is 0.12. Add with this NPV of lower discount rate, which is 24,000, divided by NPV of lower discount rate minus 8,000. Minus into minus equal plus. Remember, if you calculate two figures and this one becomes positive, then you have to minus it. You only plus this when this figure is minus. Or if both of the calculation gives you negative, then you take this figure as negative, okay? So just math rule. And then multiplying this by a higher percentage minus lower percentage, which in this case becomes 8%. So 18% closer to 12%, 20%. I'm absolutely happy with my answer. I already did these questions in the Excel, so we'll leave this. How is the payback period calculated? A capital investment project has initial investment followed by constant annual returns. When we have a project which has same cash flow every year and we are calculating payback period, simple payback period, not discounted payback period, we could take the initial investment divided by annual cash flows. Initial investment divided by annual profit, not annual profit. We take annual cash flows. Profit, remember, when you study a relevant topic, you see that some of the things that are included in profits are not relevant. So we use the term cash flows instead of profits. Initial investment divided by annual net cash inflows. Yes. So whatever we have invested, divided by cash flow. So we don't minus any residual values. So B is correct here. What is the IRR of the machine investment? A machine has an investment cost of 60,000 at time 0, present value at time 0 of the expected net cash flow from the machine over its useful life R. We have discount 10% gives us 64,000. This is present value, not net present value. Always focus on that. This is 64,000. If we take 64,600, we minus the initial investment, then it will give us NPV. 64,600, 4,600 NPV, 58, 200 minus 60,000 minus 1,952, 100 minus 7,900. Okay, so you could calculate IRR when you take these two figures as well. You can calculate IRR when you take these two figures as well. You can calculate IRR when you take these two figures as well. But IRR is mostly accurate when one figure is positive and another figure is negative. Then it is good to use those figures. So we have 10% and 15%. So I will take one positive and one negative. Because this is more closer, I will take this. So the answer is in between 10% and 15%. It is not below 10% because we have a positive here at 10%, so it should be in between. And it will be below both negatives, which is 15 and 20, but not below 10 because at 10% we have positive. So it is not between 15 and 20. If they said above 15 and 20, then it would be correct. Above these, below 15 and 20, then it would be correct. Over 20% is also wrong. But let's calculate it. The answer is B. But let's see for practice. We have 4600 divided by 4600 plus 1800 multiplied by 15% minus 10% gives us 5%. So let me adjust brackets. Let me add another bracket here. Let's do it individually. 4600. It's always good to break down formulas instead of focusing on all these brackets. So we have 0.71. We can directly multiply this by 0.075. 0.0353, so 0.10 plus 0.0359. It becomes 13.53. So 1800 is more closer to 0 than 10%, so this answer is also more closer to 13%. If I was calculating IRR using these two negatives, then I would have calculated like this. Minus 1800 lower discount rate divided by lower discount rate, minus into minus equal plus, and then NPV of higher discount rate becomes plus, multiplied by 20% minus 15% becomes 5%. So minus 0.014. So lower percentage is 15 minus 0.0148, and it gives us the same answer as the previous one. So the way you put figures in the formula depends on whether the calculations that is given is positive or negative, whether both of them are positive, whether both of them are negative, whether one is positive or whether one is negative. What is the investment at the start of a project? An investment project has a positive net present value of 722 when its cash flows are discounted at the cost of capital as 10% per year. Net cash inflows from the project are expected to be 18,000 per year for 5 years. Cumulative discount annuity factor for 5 years at 10% is 3.7. So that factor is also given. And it is for 5 years. They didn't say which year it starts. So when they don't tell you which year something starts, normally assume it starts from year 1. Okay? So what is the initial investment? Okay, NPV is 7,222 positive. So if we are receiving 18,000, then annuity factor is 3791. This will be the total amount. Total amount minus initial investment will give you NPV. So if I take total amount minus NPV, it will give me initial investment, which is 61,160. Which of the following accurately defines internal rate of return? The average annual profit from an investment expressed as a percentage of investment sum. Discount rate at which net present value of the cash flow from investment is 0. This is correct. The net present value of future cash flows, but still read all the options just to be sure. Net present value of cash flows from an investment discounted at the required rate of return. The rate at which discounted profits from an investment are 0. So these statements don't make sense. Okay, what is the discounted payback period of the investment project? Investment project has the following discounted cash flows. We have cash flows. Year 1 we have outflow, we have other years. Remember, if investment is not in year 0, it will not be valued at 90. If it is, let's say, in year 2, then the value of that will be lower. But at F2 level, it will not be that complicated. Required rate of return is 10%. So now we're calculating payback period, but we have 10% as well, we have 20% as well. We will calculate it at whatever is our required return, which is 10% here. So we're investing 90,000, present values are given, so we will only focus on this. So we have 27.3 plus 24.3. I don't believe it happens at second year. Let's add third year as well. It doesn't happen at third year as well. So let's add the fourth year as well. So at fourth year, it is higher than 95. So it is between 3 and 4 years. So answer is C here. But if you still want to calculate exact figure, then we need 90. And at third year, we have 74.6. So if we have 74.6, we need about 5.4 something, and we are receiving 20 in year 4. So divide by 20.50. So 0.75. So 3.75 years exactly. What is the effective annual rate of interest of 2.1% compounded every 3 months? So 2.1% compounded. They didn't say whether it is annual or not, so I would assume it is every 3 months, because all of the options here are more than that. So sometimes your answer is in, the question is an answer. So 2.1% compounded every 3 months, annual would be 1 multiplied by 1.0 to 1, 4 quarters annually 1.086, so 8.67% B. If the interest rate is 8%, what would you pay for perpetuity of 1500 starting in 1 year's time? 1 year time is year 1, which is normal, so don't be confused about that. If it is anything other than year 1, then it is problem. So in simple terms, they're asking what is the value of perpetuity at 1500 at 8% forever. So 18,750. What is the annual effective interest rate offered by 2 investments? An investor has a choice between 2 investments. Investment X offers interest of 4% per year, compounded semi-annually for a period of 3 years. Semi-annually means every 6 months. If it is 3 years, then it would mean 6 periods. Investment Y offers 1 interest payment of 20% at the end of its 4-year life. So Y offers 1 payment, and when we look at that 1 payment, it equals 20%. So the easiest way to answer a question like this, we have 4% per annum. So this is simple. We have 1 multiplied by 1.04, and this is per annum, so every 6 months it would be 2%. So it becomes 4.4%. Now the second one, they said becomes 4% after 4 years, and it is annual. So what I will do is I will look at these options. 5 would not be correct, obviously, because it is compounded, and when I multiply it by 4, it gives us 20% if it was simple interest. So it cannot be 4. Let's look at this other option. We have 4.66, 1 multiplied by 4.66, 1 multiplied by 1.0466, and we have 4 years, so power 4. So it becomes 1.19, which is about 20%. So we have 4% per annum 4.04% per annum for X, and 4.66 per annum for Y. A project, okay, what is the project net present value to net is dollars? A project has initial outflow of 12,000 followed by 6 equal cash inflows commencing in 1 year's time. Year 1 is normal. The payback period is exactly 4 years. The cost of capital is 12% per year. What is the project's net present value? Okay, so if we have outflow of 12,000 and we have same cash flows, 6 years, same cash flows is not given, but it is told that the payback happens in 4 years. If the payback happens in 4 years, if I divide this by 4, it will give me annual cash flows. If I take 12,000 now, I divide by 3,000, it will give me 4 years. So we are receiving 3,000 every year. So 3,000 every year at 12% annuity for 4 years. Looking at annuity table, 12% 4 year is 3.037. 3.037. 9,111. So 12,000 minus 9,111, 2,899 negative is NPV. Sorry, 911 inflows minus outflows. Remember, if you are making investment, anything other than the first year, then you have to convert this to the present value as well. Let's double check this calculation here. 2889. 2899. This figure is different. Let's look at table 1, 2, 3. Sorry, I've taken the discount factor for 4 years, but the cash flows are for 6 years. So payback happens in 4 years, but our actual cash flows are for 6 years. So we have 333 answer, which is A here. Let's say if this cash flow was not invested in year 1, if it was invested in year 3 outflow, then we would have taken this and converted it to present value. At 12%, it would have been 8,400. So then we would have minused this. So normally at F2 level, it will be at year 0, but it doesn't have to be the case. So always focus on that. So this completes investment appraisal and F2.